Pedro Antunes is the chief economist for the Conference Board of Canada. He joins me now. Mr. Antunes, good to see you again. What is the significance of this new mandate for the Bank of Canada that includes now looking at efforts to maximize employment when it takes steps to fight inflation?
Well, I mean, I think if you read the fine lines here, I don't think we're changing drastically the mandate of the Bank of Canada. We're still going to keep and target inflation at 2% within that 1 to 3% rate. Range. There is a little bit more wording and focus on keeping an eye on full employment, making sure the labor market is healthy. But I think the onus or the how should I say, the major weight of monetary policy will still be determined by inflationary pressures.
So in practical terms, what does this language change mean, do you think, for the way the bank makes decisions about how to deal with inflation?
Well, that's a really good question. I mean, I think it may, certainly in the current situation where we've just seen the labor market really on a tear in the last couple of months and, essentially back to a 6% unemployment rate nationally, which I would say is a fairly tight unemployment rate. I don't think it's going to change very much in the very short term, certainly. How the bank reacts in the future in different circumstances, I think we'll have to wait and see. Our sense from the announcement is that, not a whole lot will change in how the bank targets its changes in monetary policy going forward.
All right. So I'm guessing from your comments, you do not, I think some have suggested that it could be, but you don't view this as a watering down of the bank's focus on inflation and keeping it low.
Well, no, I don't think so. I think the Bank of Canada has always had an eye on what they call essentially, the closing the gap on the economy. And of course, that really is around labor markets and whether we are at full employment. I think that plays a major role. So I think that's always been part of the bank's objectives, even if they weren't spelled out so much so in the mandate. No, I think this is going to be kind of business as usual, and it certainly in our perspective from the Conference Board, we think this is a good thing. One of the ways, of course, that the bank maintains kind of its handle on inflation is by making sure that people believe and have their inflation expectations anchored. In other words, that they believe that the Bank of Canada will be successful in keeping inflation in that band and at 2%. So changing the mandate now, confusing the message around what the bank is targeting, et cetera, I think it would have just been bad timing in terms of where we are given the latest inflation numbers and just the expectations. We're very worried here that we may see inflation getting into these expectations, that is, getting into wages and then obviously putting pressure on prices in this kind of vicious cycle. That's what we want to avoid, and I think it was wise to keep the mandate where it is.
Okay, so let me ask you this then. Is there a point where keeping inflation low and keeping employment high could become mutually exclusive?
Well, that's always a challenge. In fact, economists have something that they look at, which is this relationship between low unemployment rates and high inflation. And this is one of the things that is difficult for the Bank of Canada to manage. We've been very, very successful at managing that over the last 30 years, in essence. And that is, again, because inflation expectations, I feel, are anchored. So we're not seeing these pressures necessarily getting into wages and driving up those, this kind of vicious or vicious cycle on prices. So no, I think it's essentially it's been a successful policy to date. I think it's wise to keep it where it is going forward. And of course, the bank, as you know, Peter, has a very limited policy measure. The measure that it has is, in essence, in normal times, certainly, is moving interest rates up and down. That's a very broad brush to take on in terms of trying to, manage where the economy is and the economic cycle.
Right. What will it mean for consumers facing inflation running at an 18-year high? Do you believe this gives the Bank of Canada, as some perhaps have suggested, the leeway to bring down inflation, perhaps, or to try to bring down inflation more slowly than it might otherwise?
Well, I think the bank here is kind of stuck in this current situation. It is stuck in a bit of a difficult position because, I think there are a number of factors driving high inflation right now that are temporary. We've seen a shock to oil prices. We've already seen that come off somewhat, so that hopefully will play out in the numbers. We've seen this, and by the way, this is not just monetary policy. This is very much, fiscal stimulus. Most of the developed world has seen, household balance sheets in great shape through this recession, and that's driving up very, very strong demand, especially for goods. So that's been driving up, excessively strong demand for goods, products, that is causing problems on the supply chain. So that's another factor that hopefully will normalize as we see, essentially consumer spending coming off. We also have a situation with, essentially with lack of skilled workers. So that's another challenge in this current crisis. And all of these things together have been driving inflation numbers up.
Okay.
Certainly for Canadians, this is essentially eroding a lot of that savings that we socked away back in 2020. It is concerning. Hopefully, we'll see those numbers getting tamer into the future.
Well, we expect to hear more about inflation and affordability issues in tomorrow's fiscal update. What in particular will you be watching for?
Well, I've got to say, and we just discussed, I think, the problems that we're seeing in terms of inflationary pressures here are not just because very soft monetary policy, very low interest rates, but also because of all the stimulus that's readily in the economy right now, both in terms of household balance sheets and businesses. So I think we are hopeful that we'll see the gas pedal ease up in essence in this economic update. Not too much, certainly not anything new in terms of new measures. We may still see some targeted programs because some industries, take transportation, tourism, are not going to be recovering very quickly, especially with the onset here of Omicron and more restrictions on travel and borders. But overall, what we're hopeful to see is less stimulus, right, especially up front, especially right now, and perhaps a better than expected fiscal situation. If some of the provinces we've seen better numbers than we had originally planned for.
Right.
Right now the federal government over 2 years, $500 billion in deficits. Hopefully, we'll see some of that in better shape than we'd heard previously.
All right, lots to look forward to. Always good to talk to you, Pedro Antunes. Thanks for your time today, and we'll talk again soon. Take care, sir.
You're welcome. It's a pleasure.